Hey, what's going on YouTube, and welcome back to Tech Conversations. I am your host Guillermo. It is April 7th. Let me know in the comment section below how you guys are doing today. As you can see, it is a red day for me, down $500 today, or about 0.6% so far. So we'll see what the rest of the day brings us. Just a reminder, we will be doing a giveaway once we reach 100,000 subscribers. Thank you all so much for your support. I really appreciate it. If you'd like to enter the giveaway, all you need to do is hit the like button down below. Make sure you subscribe to the channel, and let me know in the comment section below what your favorite stock in the stock market is right now. Now, in today's video, I want to talk about a strategy that's very cheap to enter. It'll only cost us a few dollars, and this can net us some pretty big returns if done properly. So we'll take a look at an example and kind of some things to watch for with this strategy. Let's get right into this video, guys. Let me know if any of you are using this strategy and with which stocks. So the goal from this strategy is to profit from neutral stock price action. So we're going to want to find a stock here with low volatility, stock that for the most part trades sideways, doesn't really move much up or down. And so the stock I want to use for this demo is going to be ticker symbol KO, Coca-Cola. Now please do not copy the exact same trade I'm going to show you here. This is just an example, guys. But if we take a look at Coca-Cola, this is a stock that doesn't really move that much very quickly. Week to week, it doesn't really move much. In the last week, it's kind of, been $52, $53. So this could be a potential candidate for this type of strategy. Of course, there's other things you should be checking, like earnings. Are earnings coming up? These are things that could cause the stock to move up in price or move down in price a lot. Major announcements, things like that. And I'll talk more about risk here towards the end of the video. But we're going to use Coca-Cola. Let's go over to trade Coca-Cola options. So this is going to consist of 4 contracts, and 2 of them will actually be the exact same with 3 different strike prices. And all of them will be the same type, meaning all of them are either going to be calls or all of them are going to be puts. So you can do this with either or. I'm going to do calls for this demo, but I definitely encourage you guys to kind of go ahead and check out what the difference is between, using the calls, using puts here. So we're going to use calls for this one. So the first thing I'm going to do is I want to obviously choose an expiration date. I'm going to choose April 16th since April 9th is coming up here very quickly. So let's choose April 16th for the expiration date. So the first thing I want to do here is kind of come up with a price that I think this stock will be at on expiration date. So what price do I think Coca-Cola will be on April 16th? Let's say I think it'll be at $53.50, right, which is right here. So then this is going to be the strike price I choose for the call that I'm selling. So we're going to sell call. We're actually going to sell 2 calls here, and I'll show you how we can do that in one single transaction. So I'm going to sell a call at $53.50 because that's where I think Coca-Cola will be on April 16th. So I'm going to go ahead and do this. I'm going to receive 38 cents per share. Since I'm selling this, I'm receiving a premium, 38 cents per share. Each contract controls 100 shares. I'm going to receive $38, but again, we're going to do 2 of them. So I'm actually going to receive $38 times 2, right? Or $76. Now, that being said, the next thing we're going to do is we're going to buy 2 calls here. We're going to want to buy a call where the strike price is higher than the strike price of the 2 calls that we're selling, and one where the strike price is lower than the strike price of the calls that we're selling. So let's start up here. I'm going to buy a call up here with a higher strike price. So the strike price you want to choose here should be the price that you think the stock won't go above by expiration. So let's say I don't think Coca-Cola will be above 54 on this expiration date, April 16th. Then that's the strike price I would choose. Or you choose the closest strike price to the price you think. So choose 54 here, and I'm going to buy this call. I'm going to pay 21 cents per share. There's 100 shares in each one of these contracts, $21. As you can see, it's actually turned into a call credit spread because this is actually going to be a combination of a bull call spread and a bear call spread. Now we're going to buy our call down here with the strike price lower than the strike price of the calls that we're selling. So again, what price do I think the stock won't go under by expiration on April 16th? I don't think Coca-Cola will go under 53. That would be the strike price I choose. So I'm going to buy this call now, and I'm going to pay 62 cents per share, $62 for the contract. Okay, so now we have this set up, but remember, we need to sell 2 of these. So how do we do that? Well, check this out. You go over here and then there's this drop down here. You click on that and you click on custom here. And as you can see, this will allow you to change how many contracts you want of which, any of these contracts that we have here. So for the one we're selling, we want to do 2 here. So there it is. So we're selling 2 calls at a 53.50 strike. We're buying 1 call, 54 strike, and we're buying 1 call at 53. So we have this set up. And as you can see, this is going to cost us $7, right? This is going to be a net debit. We're going to have to pay to enter this trade. It's going to be $7. And so our max loss here is defined. It's the debit that we're paying to enter this trade, which in this scenario is going to be about $7. Now our max profit is also defined. Our max profit will be the difference between the lowest and middle strike prices minus the cost to enter. So it's pretty cool because we can quickly come up with that. So the middle and lower strike prices, the difference between those. So 53.50 minus 53 is 50 minus the cost to enter, which is $7. So 50 minus 7 is $43. That's going to be our max possible profit here. Okay, this is very similar to the iron butterfly. This is actually called the long call butterfly spread, but there are some key differences and I'll kind of go over those towards the end of the video. But with that being said, let's actually go ahead and take a look at how this trade looks like. So let's go over to the options profit calculator. And if you go under advanced section here, they actually have one for this. So the butterfly spread here. And again, this is the long call butterfly spread. And so what we do here is we enter the ticker symbol. So KO, Coca-Cola, we can click on get price. So we can get the price here. And as you can see, we're buying an option, we're selling, writing 2 contracts, and then we're buying 1 contract here. And again, they're all the same type. So let's buy the lower wing here. So we're gonna buy, we're gonna do the exact same trade we just set up. So remember, we chose the expiration date of April 16th. Make sure that your expiration date is the same and that it's correct. And then remember, calls are on the left, puts are on the right. This is the long call butterfly spread, so we're interested in calls. So remember, we bought the call here at the 53 strike, so right there. Then we're going to write or sell our 2 calls here. Again, make sure expiration date is correct. Calls are on the left, and we chose the 53.50 strike here, which is right here. So we're selling, writing 2 of these. And then finally, we're going to buy a call here. We chose the 54 strike for this one, so right there. So let's take a look here at what this is going to look like. So let's do for the range here. We'll do 52 to 56, and then let's calculate this here. So this is what it's going to look like. And as you can see, it's kind of changed a little bit. I mean, these options are changing as time goes on. But as you can see, for the most part, our entry cost is $10, right? Net debit, because we're paying to enter this trade. We're paying $10. It's also our maximum risk here. That's the most we can lose is $10. So you only need $10 for this trade, which is not a lot of money. You're not putting up any collateral or anything like that. You're just paying right off the bat $10 and then hoping that you make some money here later on. Maximum return is $40. And we'll take a look at where that happens. It also gives us some break-even points. So as you can see, we want this stock to pretty much trade sideways or at least not go up or down that much. That's why you always need to, make sure that there's no earnings or major announcements that may cause the stock to move up or down dramatically. We want this to kind of stay within this defined range. Now, if we want to do our max return, let's focus on expiration date. For our max return on expiration date, we want the price of the stock to be the same as the strike that we chose for the calls that we sold. That's why we set it up that way. We want it to be 53.50 on expiration date to make our max possible profit here, which as you can see is $40, which would be a 400% return, right? Now, if we take a look here at our break evens, 53.90, 53.10. So on expiration date, if it's at 53.90, we're breaking even. If it's at 53.10, we're breaking even. If it's between those two, we are making some money, and we can actually see that here, right? How much we could be making there. Notice that prior to that, the range is definitely a lot wider. So we are basically here profiting from time decay. Now, with that being said, guys, if on expiration date, the price of Coca-Cola is above 53.90, you're going to lose money, right? You're going to lose all of your money. for the most part. So you can see here, if it's at 54, you're losing all your money. It doesn't matter how much higher you go up, you're losing all your money. But again, it's only $10. Same thing down here. If it's under 53.10, you're gonna lose all your money here. If it's under 53, you're gonna lose all your money, $10 as well. So again, this is very similar to the iron butterfly. The other thing I do want to mention here before I talk about that is there is risk of early assignment. So early assignment risk, which is generally related to dividends, is present here, right? And especially because we have short calls. And if they are assigned early, they are generally going to be assigned on the day before the ex-dividend date. So you should always be checking if the stock has a dividend and when the ex-dividend date is, because there is a higher risk of early assignment if these contracts fall on that week of that ex-dividend date. So always be watching out for that as well, guys. Now with that being said, let's talk about how closely this resembles the iron butterfly. So there are some key differences, right? One of the differences, of course, is that in an iron butterfly, you're receiving a credit, right? When you enter the trade, you're getting paid to enter that trade, and then you're putting up collateral. In this one here, this long call butterfly spread, you're actually paying a debit to enter the trade. So in the iron butterfly, you're receiving the money up front, and then you're gonna have to pay later to close out. In this scenario here, you're paying up front and then receiving money later on. And some people like one scenario or the other. It kind of depends on your preference. The other difference, of course, is that in this long call butterfly spread, right, we have all of these being the same type. These are all calls. And there's really only three, right? Because this one here, we're just purchasing two, but it's the exact same. In the iron butterfly, we're buying a put, we're selling a put, we're buying a call, we're selling a call. Might be a little bit more confusing. You have an extra contract in there as well. So that's kind of the key differences here. But if we actually were to kind of look at the graphs, they are going to be very similar. And in fact, we can do that here very quickly. So let's go over here and we're going to set up the iron butterfly for this as well. So we go here to the symbol, so KO, and let's get a price here and let's actually set this up. So remember, in the iron butterfly, we're going to buy a call, we're going to sell a call, sell a put, and then we're going to buy a put as well. So let's start with buying our call here. So we chose April 16th, calls are on the left. So let's choose the 54 strike here for this one. So 54 call here, and then we're going to write or sell a put and a call at the same strike. So expiration date April 16th. This is going to be the 53.50. So let's do the call first, and then let's write or sell our put here. So puts are on the right, 53.50, which is right there. And then let's go ahead and buy our put here. Puts are on the right, and this will be the 53 strike, so right there. So we have set that up, and remember the range we chose was 52 to 56. So let's go ahead and calculate this. Let's see what this looks like. So as you can see, it's going to be very similar. If you take a look, again, like I mentioned, one of the big differences is that in the butterfly spread, you're paying, it's a net debit. Here, you're getting a net credit. So here, you're going to receive $41. You're going to have to put up some collateral. Your max risk is going to be $9. But it's, for the most part, going to be very similar. And if you take a look here, this is kind of what the differences would look like here. So very similar. I definitely encourage you guys to kind of play around with those two to kind of, feel for both of them, which one you prefer. But anyways, that is the long call butterfly spread, guys. If you have any questions, definitely feel free to leave them in the comments section below. Check out the Discord, link to it in the description below. I hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.